Glencore will buy a majority stake in Teck Resources' coal business, ending a 7-month-long saga that transfixed the mining industry. The two companies have spent much of the year in a bitter public fight after Teck rejected an unsolicited $23 billion takeover offer for the whole company, which of course disrupted Teck's own plans to spin off the business. Now Glencore is buying a 77% stake in the coal business, with the rest going to steelmakers Nippon of Japan and POSCO of South Korea. CEO Jonathan Price hailed the deal as a major step forward for Teck Resources, but it's still one that requires regulatory approval. Joining us now for discussion of what is and what will be Jonathan Price, CEO of Teck Resources. Thank you so much for being with us, Jonathan. I want to start first with the merits of this deal. Throughout the past several months, you talked about how many options were on the table. Why was this one the clear winner?
Hi, Amber. Thanks very much for having me on today. Look, we're very excited with the transaction that we've announced today. We heard very clearly from our shareholders over recent months that they wanted to see a simple and complete separation of the steelmaking, coal and base metals businesses that Teck currently holds. And this transaction very much delivers on that. This is a significant step forward in unlocking the value of our base metals business and really establishing Teck as a Canadian-based global critical minerals champion, and we expect to see significant value unlocked through the separation of these businesses. Finally, we've really set up a strong future here for Elk Valley Resources, the steelmaking coal business. Glencore have committed to a significant package of undertakings here, which confer enhanced benefits on the Elk Valley, on British Columbia, and on Canada. This has been a product of an extensive, robust, and comprehensive process involving multiple counterparties with multiple different proposals. Ultimately, what Glencore brought to the table here, along with Nippon and POSCO, offered us the best means of meeting our objectives of a complete separation, of creating value for Teck shareholders and setting up EVR for a strong and successful future.
There were a lot of bitter words exchanged between Teck and Glencore, and a lot of accusations about Glencore as an operator. How do you then turn that around to the Canadian government and sell them this deal that really does involve Glencore?
Look, so this, is an entirely different situation from the one we were engaged with on Glencore earlier this year, very much focused on the steelmaking coal business here in British Columbia. Through those undertakings I mentioned and the enhanced benefits, we'll see Glencore committing to maintaining employment levels in Canada and in the coal business, committing to a Vancouver-based headquarters for the coal business, committing to additional investment in that business in the years ahead, particularly in the areas of research and development and community investment, and also maintaining or enhancing all of the social and environmental programs that Teck has in place today. So, we see this very much as the responsible separation that we've been looking for, and we believe that the commitments that Glencore has put forward here are very good for the Elk Valley, for British Columbia, and good for Canada.
We're seeing a bit of a muted reaction right now in the share price. Can you take me through some of the alternatives that you studied, and whether this was an example of you maybe favoring structure over value, given the messages you were getting from shareholders about what kind of involvement they wanted to have in the coal business?
We very much put the creation of shareholder value here front and center in everything we did. We believe this transaction does deliver the best value for our shareholders, as well as delivering the best outcome for all of our stakeholders. From a structural perspective, we did want to achieve a complete separation of the steelmaking, coal and base metals business, which we've done through this deal. But we didn't do that at the expense of value and value creation, both through the consideration paid for EVR, as well as the ability to unlock future value in our metals business, were at the forefront of all of our thinking and decision making here.
A few months ago, the chairman of JSW Steel of India gave an interview that suggested that a deal or a tie-up with Teck Resources was all but a done deal. Since then, there had been geopolitical tensions that erupted between Canada and India. Did any of that factor into your ability to do deals?
Look, there have been numerous counterparties involved in this transaction for many, many months. Ultimately, the deal we've announced here with Glencore, Nippon, and POSCO is very much the best one. I would say that the situation between Canada and India had no direct bearing on this process.
And I wonder, will it have a bearing on regulatory approval? You're very confident about regulatory approval in Canada, but on the conference call you noted 11 jurisdictions need to approve this. Are India and China two of those?
Yeah, there are approvals in 11 jurisdictions. They relate to antitrust, and typically they're related to the key markets into which the coal will be sold. Again, we're confident in obtaining those approvals. They tend to be very much in the normal course for a transaction of this nature. And in addition to that, as you mentioned, there is a federal approval from the Government of Canada.
Glencore, of course, wanted to buy the whole company now that they have this coal business. Can they come back for the copper business?
Look, our strategy is very much to continue with the ramp up of QB2, which is our flagship copper operation in Chile, and we'll bring that to full production by the end of this year and continue to run that through next year. We'll generate significant additional EBITDA and cash flow for Teck from that. Beyond that, we have projects here in Canada, including the HVC copper mine that we have in British Columbia, and there's a life extension project there. Also, there's the opportunity for an electric vehicle battery recycling facility at Trail, also in British Columbia, as well as future copper projects in Mexico, Peru, and Chile. So in addition to QB2, we have a range of copper investment opportunities ahead of us here, which we believe is the best path to uncover significant value for Teck shareholders going forward.
It's a deal that leaves you with a lot of dry powder. And of course, investors want to know how much of that will be returned in the form of a special dividend. Where is the board's thinking on that?
So we will act in accordance with our capital allocation framework, which is essentially to balance three priorities. The first is to make sure the balance sheet is in good shape. So it's likely that we will reduce debt using part of these proceeds. Secondly, we will deploy some of the cash to some of the projects that I just referenced, including those in Canada and in South America. And beyond that, of course, when we have cash surplus to our needs, we always look to return that to our shareholders. We said there would be a significant cash return to shareholders as a result of this transaction. The exact quantum and form of that, whether through a special dividend or a buyback, will be determined by the board at or around the time of completion of the transaction.
What about M&A? Of course, I know you're not going to comment explicitly on M&A, but I wonder if you could comment on the opportunities for M&A, the companies that are out there, the valuations that currently are being sought, and whether it's an attractive environment right now for Teck to do deals for copper assets.
Look, the primary focus of our strategy is the development of the copper projects that we have in the portfolio today. That's quite unique to Teck. It's very hard to find other companies with maybe one good copper project right now, and we have multiples of them. So we're in an envious position there, and we think that is the best route to unlock value for our shareholders. Of course, we always keep an eye on transactions in the market and think opportunistically like other players do. But it's really that organic pipeline of projects that's front and center in our value creation strategy at present.
I wonder if you could be opportunistic. There's a high-profile case of First Quantum, for example, struggling due to geopolitics in Panama. Is that something that you've looked at to be opportunistic?
Look, I think what we focus on is the portfolio we have today. We focus on the jurisdictions in which we operate, being the US, Canada, Peru, and Chile, and in future the potential for a project in Mexico. I think we always talk about below ground risk and above ground risk, and below ground goes to the quality of resources, and above ground goes to the geopolitics that you reference, and we strike to get that balance right through the countries in which we invest and the projects that we choose to develop.
Of course, this is a play on these critical minerals that are used for the green energy transition. And there's a lot of enthusiasm about the role that, something like copper will play into that. and yet copper has come off since its peak. How do you think about, and part of that is due to weakness in China. What is your view on the copper price, and does that kind of pullback make you skittish about the future?
Our view on the medium to long term for copper pricing, it remains very constructive. There's going to be a significant increase in demand related to decarbonisation and electrification, and really a lack of new projects and development options to meet that demand. So given that supply-demand dynamic, we expect there to be a very strong copper pricing environment going forward. In the near term, right now, there is some oversupply in copper markets as additional new mines have come online in the last 1 to 2 years. But we expect that oversupply to be worked out fairly quickly, and we'll see that strength in copper markets emerge maybe 2 years down the track. Just to your point on China, actually overall, imports of copper to China this year have been extremely strong. There's been a bit of a change away from them importing refined copper to copper concentrates, but overall imports of copper units are up. And again, that is driven by electrification and in particular the build out of their transmission infrastructure.
Without the cash flows coming from the coal business, how does Teck Resources make sure that they're able to capitalize on that growth that they see for the future? Might you have to do some financing where those cash flows would have been, or does the deal sort of make up for that?
Look, two aspects to that, Amber. I mean, firstly, as we bring QB2 online to full production, that adds significant new cash flow generation to our portfolio, essentially replacing much, if not all, of the cash flows that have been generated for us by the steelmaking coal business. In addition, as you referenced, through this transaction, we get significant upfront cash proceeds with $8.6 billion US of proceeds coming from Glencore and Nippon as they buy EVR. And secondly, we retain full access to the cash flows from that coal business until completion of the transaction, which is expected to be in the third quarter of next year. So we have a number of sources of cash coming into Teck, which gives us significant optionality for investment going forward.
Does this deal solidify Teck as a Canadian champion?
Absolutely, a Canadian-based global critical minerals champion. We work very closely with the government of Canada and the province here in British Columbia to support their critical minerals strategy and intend to work in partnership with them going